All right, let's see. Welcome to Wall Street Wednesday. Today is December 16th, 2020. This is episode number 27. Welcome to Wall Street Wednesday. Let's see. I'm trying to, there's a bunch of pictures there. All right. So I'm just patiently waiting. It's Wednesday, 1 o'clock. A number of you might actually be trading the markets, out and about doing some things. So I'll give it a few minutes for people to join. And then from there, if no one joins, I'm okay with that because I have a lot to talk about today. I think it's interesting what I have to talk about. So again, the goal in everything we talk about is on how to make money. So I will be sharing some very unique things today, reviewing so that we can actually go out there and make some money. Welcome. Afternoon, everybody. Welcome. So what is this? I think, we got one more week before Christmas. So we have another broadcast next Wednesday, then Christmas on Friday. So again, I'm really excited about what's going on out there in the marketplace. I think there's some, I'm about to share some things out there that can put some money in your pocket, as well as some recent new IPOs. So I'm going to go into that in a little detail. I'm just going to wait maybe a couple more minutes. And as I said earlier, whether I have one person on this call or two people on this call, right now I have 3 people. So I got Brian on here. Welcome, Brian. I've got Superstar on here, and I got the great legend himself, Gene Smith. So I want to welcome you guys. And I'm going to talk about some things to put some money in your pocket. So I'm just going to, let me do this. Let me start off with this as I just give people a chance to sign in. So one of the things I wanted to talk about is people sign in. Welcome, Mikey. One of the things I want to talk about is, just looking at the screen, is that on Monday, you guys know that one of the ways I track the market is using the volatility index, the VIX. And the thing I look for in the VIX is a penetration of the upper Bollinger Band. Well, on Monday, the VIX penetrated the upper Bollinger Band. Now, the VIX has not been showing a lot of volatility, but when you penetrate the upper Bollinger Band, it basically is a bullish call for the market over the next 30 days. Welcome, Troy. So the VIX gave us a bullish market, a good signal over the last, since Monday. So we'll see how that plays out. But again, that's what I do. Now, one of the things I also want to mention before I go into this in a little more detail is that you're coming into year end. And as I told you guys before, year end, there's a lot of portfolio managers are out there, what we call doing, I'm sorry, my screen just did something crazy. I'm not sure what it did. So anyway, a lot of portfolio managers out there right now doing what we call window dressing. So I know I'm repeating myself from last week, but window dressing is a lot of them will sell their losers to get that tax loss that they can use it to offset capital gains. If they like the stock itself, they're going to sell it and look to buy it back in January. So you're seeing a lot of manipulation like that, profit taking, cutting losses, repositioning the portfolio for year end. The reason why I call it window dressing is, and I'm just going to use it for instance, me, which I do not like, I've never traded Tesla. Don't trade Tesla. There's a number of reasons why I'm not going to go into it. But if I was trying to impress my clients, what I might do really is buy some Tesla to put in the portfolio here to wrap up the year end. And so that way they look and say, well, we got a position in Tesla. It's kind of amazing what some of these guys do. So I'm not going to get into that too much. But again, welcome guys, welcome. All right, so let me get started. A couple things. Let's go about last week. Last week we talked about Airbnb and we talked about Dash. When we talked about DoorDash, I had mentioned I thought the stock was overvalued at this level. DoorDash was worth more than Chipotle and several other restaurants that they make deliveries from. So I was not and still am not a big fan of Chipotle. Excuse me, not Chipotle, of DoorDash at this price level. I had told you that based upon the way the stock was trading, I thought it would test the 163 opening low, which was the opening price. And of course, it did test the 163 and broke down from there. So now the good news is One is I told you guys the short dash. It was if you could find stock to borrow, it's hard to find stock to borrow. But Dash now, as well as Airbnb, what else? Who else came public? Dash, Airbnb, they now have options. So now you can actually trade the options. So if you still want to get short Airbnb or DoorDash, you can actually just buy the puts. I'm not sure where they go from here. I think they still trend downward or trade sideways. There might even be some more behind it. So I'm not sure what to do with the stock. So I'm going to just give it some time and watch. The one thing I'll say is on neither stock right now, I'm not bullish on either Airbnb or DoorDash. So we'll see how they trade from here. All right, so you got that. We brought that up. I brought that up. I talked about that. Let me talk about what I'm excited about. There are several IPOs that have just become public since we spoke last. When I say several, 2 or 3 that I really, really like going forward. Again, I like them. I'm researching them. I'm following them. Does not mean I'm going to trade them, but I'd be surprised if I didn't. Now, before I go into that, let me switch to this real quick. And I got to switch to this. What you're looking at is my PRCSMM model, PRCSMM. And as you can see, which I posted for you guys, you can see the chart. PRCSMM is an acronym, and P stands for product and service, R stands for reward to risk, C stands for capital, S stands for scalable, M stands for market, and M stands for management. That's PRCSMM. Now, let me give you a little background. I started trading IPOs and have been trading IPOs for years. From the IPO market, I also moved into the private equity market. And looking at companies and studying companies for the last, I was about to say 30 years, but it's actually been longer than 30 years now. For the last 30 some odd years, 30 plus years, I found that these 6 criteria are in all very successful corporations. Now, the reason why I bring this up is that, and I'm going to make a statement. You guys can agree with me, disagree, but I think you'll agree with me. My statement is this. I find it much easier to trade and make money in stocks that are going higher than stocks that are going sideways or going down. In essence, what I'm saying to you is, and I'm not offended by this, anybody that purchased Amazon, Google, Apple 2-3 years ago might consider themselves a great trader. I'm not sure if you're a great trader more than if you're a great company and great stock picker. So one of my contention right now, and the reason why I brought this model up is I trade a lot of stocks, a lot of different stocks. The ones that I trade that have made the most money for me, and the ones that I typically stay long and trade them and buy them and hold them, are the ones that fit these 6 criteria. So let me explain what they are. P, product and service. And I'll be brief. I apologize. If you have any questions, feel free to ask. I'll be brief. And now I'm going to switch so you can see me. I'll keep this in the corner. So let me switch this up. All right. So P stands for product or service. What we're looking for is a company that has a product or service that is the industry leader or could be on its way to becoming the industry leader, that its product or service could actually eventually become the industry standard. So again, product and service. New product, new service coming to the marketplace. They're best of breed, or we think they're on the way to being best of breed. That is product or service. You'll hear the term disruptive, and I want you to think about it. And I'll give you an example of a disruptive industry, a disruptive service. The internet. The internet changed businesses. It has become a standard. The internet has become the other utility that comes into your house. You have electric, gas, water. The other one is the internet. That's the other utility. All right. That's a product or service that's been disruptive. Let me give you another example. I'm thinking real quick. Real simple one. I'm going back some years, and that's okay. You'll get the idea. Home Depot. Prior to Home Depot, if you wanted anything dealing with your house, repairs, hardware, that nature, you had to go to a hardware store, the local store in your neighborhood. What happened was Home Depot came, crushed that category. If you notice now and you look, especially younger generations, there are no hardware stores on the corner. Anytime you need something to fix your house, repair inside your house, the first thing you say is, let me go over to Home Depot. All right? That product slash service now has become the standard. All right? After that, we have reward to risk. You've heard me say this a number of times. I was looking at some stocks this morning. And when I looked at the stock this morning, one of the things I saw was, I said, wow, this stock is really running. Maybe this is a stock I want to buy and trade. Everything looked good on it. Then I went and looked and said, wait a minute. This stock has been in an upward trend for the last 3 months, and the stock basically went from $15 to $20. The move is just not enough for me. All right? The reward was just not there. So when I take on these positions, the thing I look at is, if I'm right on the trade, how much upside do I have? All right? That's reward to risk. Making money. Again, we're doing this to put money in our pocket. If you're doing it for any other reason, I'm not your guy and you shouldn't be on this call. You do this to make money. Now, the other thing about this, sorry about that, guys. All right, so that's the R. C, capital. What are they going to use the money they raise for? What are they doing with the cash they generate from the corporation? What are they doing with that capital? I want to know. Now, if they're taking that capital and, for argument's sake, I saw one corporation that they were taking all their capital to try and pay down some of their debt. When I went and took a look, even with the money they were using to pay down the debt, they still were tremendously over-levered. And the company ended up eventually actually going bankrupt. So I want to know what they're doing with the cash. What are you doing? Now, I looked at another company this morning that I looked at the price action, and the stock looked really good. Things were going well with the stock. I went and looked at it, and they're raising money, and the money they're raising is basically to go for phase 1 and phase 2 testing on some new drugs that they have in the pipeline. Anyone that knows me and heard me talk knows that I do not like the biotechs. The reason why I don't like the biotechs is for that reason of the FDA approvals, stage 1, stage 2, and stage 3. So many things can happen along that way. So going back to capital, I want to see what they're using the money for. Believe it or not, I like it when they're using it for general corporate purposes, but that's another story. All right, so we got the P, we got the R, we got the C. Next is scalable. When I look at scalable, I want to look and say how quickly can they go from, argument's sake, one customer to 1,000 to 10,000 to 100,000 customers without significantly incurring or increasing cost. That's a scalable business. All right. Most of your software and technology companies, in terms of applications, are scalable. And what I mean by that, if they have one person using the online application, or they have 10,000 or 100,000 or 1,000,000, for them, all their costs were up front in terms of developing the application, developing the software. Now I'm going to go the other direction. A company that's not scalable, all right, and that was Tesla. Tesla could not go from manufacturing 10,000 cars to 20,000 cars without making a significant investment in plant, property, and equipment. That's one of the reasons why I never liked it, did not want to trade Tesla. Now, the other side, Amazon, believe it or not, does not run a scalable business. They spend a lot of money in developing these other businesses, but they've also managed to generate enough cash flow that it comes down to the bottom line and drives up stock price. Now, again, I don't want to get too into this. I just want you to understand the basics on this. I wrote a book all about it. You can go into, Amazon. The book's on Amazon. You can buy the book. So it goes through all these in detail. Now, we did price them. We did the P, we did the R, we did the C, we did the S. Now M, market. Let's do market first. I want to invest in companies that are in a market or industry that is hot and growing. I do not want to invest in a market or industry that is decreasing in size. Example, I mentioned this before, I'll mention it again. Western Digital, manufacturer of C drives. Who else? Dell Computer, manufacturer of laptop computers and desktop computers. basically about 5 or 6 years ago, as more and more of us moved away from laptop computers and moved towards iPads, iPhones, and things of that nature, we stopped buying computers. And those two companies took it on the chin. One of the things, I had a student that actually wanted to recommend Western Digital. That's why I brought it up. When I talked to her, I said, look, Western Digital, the market that they're in is shrinking. They might be the best company, but they're the best company in a shrinking market. Think about this from a business owner standpoint. You might be the best of breed, but if you're in a market where the use or desire for your product is decreasing, demand is decreasing, as well as your profit margin, don't want to be there. I want to be in companies that are in markets that are expanding, double digit. I'm looking for the industry market that's growing by 10, 15, 20%, if not more. I want to see that growth. Now, I have invested in some companies that, believe it or not, there was no market for them. They basically were the industry leader. They opened up the doors and they became the new standard. One that comes to mind right now is Roku. Just comes to mind. It's the only pure play in that industry if you want to actually get TV signals to your TV and internet TV. All right, and last but not least is management. I want to know who's running the company. What are their credentials? Where'd they come from? Do they know what they're doing? You know, there's a saying on Wall Street, we bet on jockeys, not on horses. I've seen some major corporations that had the wrong management make all the wrong moves and the company just did not do well. I've seen other ones where the company was only an average company, but because of management's ability and management skill and knowledge, they drove up the price of the stock. All right, that's my pricing criteria. I look for all 6 of those key points to be in a positive area, positive way, that everything's going in the right direction. Those are the companies I want to trade. Those are the companies I want to invest in. Those are the companies I want to own long term. I started out by saying this, and I'll say it again. What companies fit this? Facebook, Apple, Amazon, Google. Think about it. How hard was it to trade those stocks over the last 2, 3, 4 years? They're not hard to trade when they're in an upward trend. They're not hard to trade when they're great companies. The company can bail you out when you buy it at the wrong time, because if you stay with it and have time, you'll make money. Now let me jump. Bear with me a second. Sorry about that, guys. Let me jump to. Come on, where are my pictures at? There you go. Let me jump to where I want to go next. Now, I wanted to come here. Now, you don't know what you're looking at. I'm going to leave it this big for a minute, for a second. I'm in the background. I know you're going to have a hard time seeing it. What you're looking at this is from the prospectus from the IPO Upstart. I'm going to talk about Upstart. Upstart's on my watch list, so I'm watching it. It's an artificial intelligence corporation that just went public today. It was priced at, let me get my numbers right, it was priced at $20 a share, and it closed today at $28.45 with a high of $30. My kind of stock. But here's what's going on. If you look at this, what you have in front of you is a list of the shareholders, the largest shareholders, senior management, and also the institutional investors. And what I want you to see is, look at the funds that are in here. You have Storage Ridge Trust. I can't pronounce the next one. Kaloa Ventures, it looks like. Again, I'm reading, it's really small print, you guys know. First Round Capital. And then underneath that, you can see that there's some other shareholders. All right. I look to see who management is, who's involved in this company, who's invested, who's up in here, who's running it. And when I looked at this, I got really excited. So my point in saying this, and the reason why I'm showing this is I pulled this out of the prospectus this morning. I was looking at Upstarts, one of the things I did. And when I went through, I was like, wow, this is impressive. Here's the Upstart prospectus. This is the one I looked at. It's not the final prospectus, but it's prospectus. Again, you might not know what you're reading. You might not know what you're reading, but I'm here to tell you something. And when you start going through the prospectuses on these young companies, especially when you look at the ones that were successful prior to this, you're going to be amazed. I encourage you to read prospectuses I know they're boring, they're hard, there's a lot of legalese in there, but there's also some things in that will educate you about the industry that they're in, about the company. All right. Before I go any further, again, this is what I look at. There's a whole bunch of other criteria I look at. And I guess the thing I'm going to say to you is, I'm switching back to this. The inside is who's selling shares, who's not, who's holding on to stock. The thing I'm going to say to you guys is this. Every corporation that goes public that has heavy insider buying, as well as VCs and private equity guys, does not guarantee it's going to be successful. But what I have noticed is the ones that don't have heavy insider owning and go public, or the insiders sell a lot of stock, or senior management sells stock, and they don't have a lot invested in the company, those are the ones that don't do well. So for me, when I don't see this, it raises a red flag. All right? Make sure you understand what I'm saying. There's no guarantee because all these insiders own the stock it's going to do well. But my experience has been when you don't have heavy insider ownership, when you don't have the VCs and the private equity guys and they're pushing behind this, my experience has been is that those are the ones typically that do not do as well. All right. So I kind of brought it up indirectly. I'm going to go back to it once again. I went through and looked at this Upstart. I like Upstart. Upstart is a artificial intelligence corporation. I got to dig into it more, so I can't give you all the details. But also at the same time, a company that came public last week, which was C3, make sure I'm pronouncing it right, C3 AI, another AI company. I like that one too. That's on my watch list. I believe the old high, well, I'm looking at the chart right now, the old high on AI, which was set, let's see, on the third day of trading was $132, $133. All right, that's my price target, guys. You know, I'll dig on my AI, the symbol's AI, but that's my price target. Like the sector, and when you go through the prospectus, I encourage you to go through the prospectus. They're free, they're easy to read. Well, I shouldn't say easy to read, but go through the prospectus, go to the selling shareholders, and the one thing you'll see on AI is the same thing that you see on Upstart, and that is the insiders aren't selling stock. They're holding on. And as I mentioned to you last week, the investment banking model is, especially when there's VCs and private equity guys that help bring the company to the public. Their model is bring the company public, do not sell any stock. Wait 2, 3, 6 months, depending on how well things go, drive up the stock price, and then do a seasoned secondary offering, a seasoned public offering, which means they're selling more IPO stock, but at the current market price. I mentioned to you last week that I saw it in four squares. They did it. Stock ran. That's the model. That's what they run. That's what they do. So we're going to do the same thing. We're going to look to get into these companies. We're going to look to do like the investment bankers do, and what the insiders do. When I say the VCs and private equity, we're going to buy these stocks. We're going to watch them run up. As they run up, we're going to sell them. We're going to do just like they do. We're going to sell them. You know, when they do their secondary offer, we're going to look to either take profits and or buy more on weakness. But again, that's what we do. All right. Bear with me a second. I'm sorry. I'm just checking. Oh, always got to check my time. All right. Let me close this out for a minute. No, I don't want to close this out. I want to go here. And again, what you're looking at now is the intraday, I believe it's 15-minute price chart on Upstart. So as I told you, Upstart was priced at $20 a share. It looks like Upstart, which I'm pretty sure opened up somewhere near 26. And then as you can see, it went down and ran. Now you're looking at a 15-minute intraday chart. The stock did close. I'm going to put it up on my big screen for me to see again. UPST. Write the symbol down. UPST. All right. Let me come out of this again. I'll leave it up there in the corner for now. Yeah, so the stock looks like it closed at, as I said, $30. And yeah, it opened up at 26, and you can see it just ran from there. So that's Upstart. Another stock that I'm interested in looking at. Now, let me go in the other direction. let me go another direction. When a company goes public, actually, let me get a little filler here. Before a company goes public, they do what's called a roadshow. Senior management investment bankers go around the country. Now, because of the pandemic, they're probably doing everything online. They're doing everything online. So they're doing everything online, excuse me. They're not traveling the country. So they're doing Zoom meetings, they're doing individual Zoom meetings, they're doing group Zoom meetings, but they're doing Zoom meetings. The purpose of this is to go around and tell all the institutional investors all the good news, all the news on the company. They're trying to basically drum up demand. They're going to talk about the growth rate, what's going on with the business, what they see going forward in the future. And these institutional investors that are sitting there are people like me. And what I mean by that is we can take those numbers, what they're forecasting for growth rate and revenue and expenses, we can take those numbers and we can forecast what we think the stock's value will be 2, 3, 4, 5 years from now. All right, we can do what we call valuation. All right, with all that going on, and by the way, in the prospectus and with all this information is the closest thing you'll get to what I call inside information. They're going to tell you everything you need to know about the company. This is why you'll see these companies priced, open up, and go higher. Now, one of the stocks that was priced today, not only did it not go higher, it was priced at 24 and opened up at, make sure my number's right, $22.75. It was ContextLogic. You guys know them by, you'll see it all the time, WISH, W-I-S-H, that's the symbol. Stock was priced at $24 a share. And there's the chart. Priced at $24 a share. Stock opened up at $22.75 and closed today. Make sure I get this right. Hold on a second. I want to make sure I get this right. And closed today at $20.20, 2020. With all this good news on the company, with them going around Wall Street and talking to senior management, and telling everybody how great the company is and what to expect and what they can do going forward in earnings and so forth, and professionals sitting down and going through evaluation, these institutional investors, and as soon as this thing was priced, the only thing they could think about was how quick can I sell the stock? So the stock, again, priced at 24, that's where the investment bankers typically sit there on what we call the syndicate bid and hold the stock price up. That's typically where they sit. Well, they didn't even sit there at 24. They opened the thing at 22.75. And you can see what happened. It just went straight down from there. So, Milligan IPO strategy. As soon as you can, get short. Repeat, get short WISH. Now, you can't borrow the stock probably because it's really tight. Goldman's going to keep a tight book on this and not allow you to borrow stock to get short. So it might take you a day, 2 days, 3 days for some certificates to be available. The other thing too is that there aren't any options on the stock yet. So be patient with it. But again, it's something that you can short. Now, before I forget mentioning options, just so you know, Airbnb, there are options available now. DoorDash, they actually now have options. And most of these bigger companies, when they go public, typically within 5 business days, on the 5th business day, you're going to see options. So for all you guys that want to trade DoorDash and Airbnb going forward, there are options on it now. Also, artificial intelligence, C3A1, with the one I'm watching, they also have options now. So one of the things that I'm saying to you is that depending on what's going on with that stock and when I get involved with it, will depend on, I might actually be going long the option instead of going long the stock. But I will trade the options. I shouldn't say I'm going to. I'm going to trade the stocks most likely. So again, read it real quick. My list that I'm watching right now. In fact, I believe I'm trying to, come on, where you at? Oh, well. I'm trying to, and I guess I don't know how to do it. I'm trying to actually type into the chat box. So one of you guys, if you could help me out, as I say the names and give you the symbols, can you just type it up? One is SEER, SEER, SEER. SEER is a biotech company. One of the reasons why I like SEER is because SEER, I believe the number, I think I had told you this, the number was, I think they raised 145, 150 million when they went public. At the same time, thank you. The same time that they went public, they had heavy VC buying. The same VCs that were in the company, the same VCs that we know all the names, they came out and brought another $135 million worth of stock at the IPO price. So make sure you understand this. The VCs that are involved in the company from day one, before they went public, as they were going public, they came back into the marketplace through a private placement and brought another $135 million worth of stock at the IPO price. All right, it doesn't get any bullish than that. Now, it's a biotech. Well, actually, they do testing for biotech. So it's in that industry, and you know how I feel about that industry, but I really am looking at it. Don't be surprised if you hear that I brought it. Now, the other stock I'm also looking at, which I also mentioned just now, is AI, which is C3-AI, and the symbol is AI. So if someone could type up the symbol AI for me, that's another one I'm watching. I already gave you that scoop, that story. And then the last one I'm watching is Upstart, UPST, UPST. Oh, I shouldn't say that. That's on the long side, UPST. It's on the long side, UPST. Now, on the short side, I will look to short Wish, W-I-S-H. I will look to short Wish, W-I-S-H. I'm going to look in two areas. One, I'm going to keep checking to see if there's stock available. And two, I'm going to see if and when they bring options. Now, something like Wish that's not doing well from the jump, the investment bankers might try and hold off on trying to bring those options to the public. But again, I'll check in 5 days. If there are options, I'll probably use puts and trade to trade this to the downside. Now, the last thing on Wish, I have to actually watch where the stock's trading. So right now, if I could, I'd be short now. I have to see what happens between now and when I can find stock and when when the options are available. But I would play that to the short side. All right, that is my most recent list. Now, I'm still long a whole bunch of these IPOs. They're trading really well. A bunch of them have formed trading ranges. But that's what's going on. Now, I have some other good news for you. And the other good news is this, I'm on break right now from teaching. So this week is finals week. I'll be on break between now and basically till the end of January. I have mentioned this before. I'll mention it again. I started a book on my IPO strategy back in 2006, 2007. I did not bring it, publish it because the market crashed in 2008, and I just didn't want it. I just didn't think there was a demand for IPO investing in 2008 and 9. In fact, in 2008, I think there was a total of maybe 25 or 30 deals done. So I didn't see a need. Dusted it off. I had some students ask me about it, dusted it off and started putting it all together again. And then Lily was working on it, and then we imploded again, as you know, back in January, February, so it slowed me down. But I'm going to finish it up. The book is pretty much done. It's now just about illustrating it and just proofreading and so forth and so on. When the book is done, I'll guys let you know. The book is nothing but on how to trade IPO stocks. I mean, that's it. Hot stocks, hot IPOs, cold IPOs, flat IPOs, how to make money in the IPO market. And again, for those who don't know, and I said it before, I've made more money trading IPOs in the aftermarket once they got started trading than I ever made in the actual IPO market. And I made a bunch of money in the IPO market. I can if I start naming some of the companies that I have actually traded from the IPO, and I'm talking about when I actually got IPO stock. And this theory, this strategy was developed out of that knowledge, out of that expertise, out of that experience I had trading IPO stocks. All right. I think I covered everything that I had to cover. So if you have any questions, now is the time to ask. Ham, you're not sick. You're saying my strategy's sick, or you're saying you're sick? I think you're saying that my strategy's sick. I hope that's what you're saying. But I'm open to any questions that you guys might have, any issues, any concerns. How's it going? I know some of you are trading. I know that some of you, I got to remember the name. LRXR. Nope, that wasn't it. Oh, that's right. Was it LXRX? Is that it? Yes, Lexicon Pharmaceuticals. So I know, I'm not sure who's on the call now, but I know a couple of you actually made some money trading this Lexicon Pharmaceuticals. I saw some news on that. Have you gone over the similarities in Snow IPO to Airbnb IPO? No, because I don't think there's a lot of similarities between Snow and Airbnb. Great question, Will. So here's the deal. I don't think they're in the same category. So I know that you missed it earlier. I went through my pricing criteria, product, risk reward, capital, scalable, market, and management. And Snow falls into that category. Snow fits all those. Be careful with, I shouldn't say be careful. Keep an eye on Snow. Keep an eye on Snow. Snow could end up being one of these FANG type companies in 3, 4, 5 years. Really, really interesting, impressive what they're doing. Airbnb on the other side is the complete opposite. All right. I don't see any product uniqueness. The uniqueness in the product came when they were actually private. Now that they're a publicly traded company, I don't see anything. In fact, I think there's more downside risk to Airbnb than upside. And the reason being is that, in essence, all Airbnb has done is built a network where people who want to rent out their homes can jump onto that platform and find it. They were first to market, they've developed a market, but competition's coming. I don't see, and there's no barrier of entry for anybody that wants to compete in this business. So where's your barrier of entry? There is none. So I'm not a big fan on Airbnb. I think the money was made. I think from here, it's just going to be like a lot of the housing, or I should say hotel or leisure stocks, where it's going to basically float up and down. And the other thing too that also makes me nervous about Airbnb, whether it's right or wrong, I know some people that are using it, use it and have property listed there. The other thing too is that they've all seen a somewhat downward turn recently based upon the pandemic and people not traveling. So I'm just not a big fan of Airbnb. I don't think it has the same upside as Snow. The other thing that you also look at Snow is, remember, when it comes to management, the other thing about it is not only people running the company in Snow, but look at who the investors are. The institutional investors that brought the stock and pushed it to $400 a share. Those are the ones who are pushing this thing. They're the ones who invested in this. All right. So I guess you can tell that I'm a fan of Snow. Snow had come down a little bit. I think though it's down to 3. I can tell you right now, Snow is down to 329. Our price when we got involved was 319. I did book some profits in Snow, but I also, guess what? I booked some profits in Snow and I'm still long Snow. I booked some profit in Snow just to put some money in my pocket. And by the way, let me mention that again. There's nothing wrong from time to time just closing out a position to put some money in your pocket. One of the things that my experience, let me say it again, my experience, which I'm going to share with you guys. My strategy works. I have several strategies, but none of my strategies are 100%. None. All right. So can I actually be in one of my strategies in my next 3, 4 trades, 5 trades, lose money? And the answer is, yeah, I've been in there. I've been there and done that. And when I go on a streak of what I call not making money, printing red ink, when I go on a streak 3, 4, 5 days, 5 trades, and I'm not making money, one of the things I'll say is to put myself in a more positive light, I'm going to start booking some profits. I'm going to start printing, I call it printing money, putting some black ink on there. And the reason being is, and I go back to my baseball analogy, if you keep striking out, your goal is what? At some point you say, look, let me just get a base hit. Let me just get back on base. If If I can get on base, maybe I can start some things happening. In basketball, a great shooter might miss 4, 5, 10 shots in a row. And you know, when you talk to them in their mind, they're going, but I'm going to make the next 10 in a row. And so the deal is, if the strategy works, if you're a great jump shooter and you miss 10 in a row, you're going to play the averages. You're going to probably make another 10 in a row. All right? That's how we got to look at this. So when you're trading and you're constantly losing money, one of the things that will put a smile on your face is to go and start printing some black ink. Even if it's only making $10, $20, $50, $1,000, whatever that number is, just keep printing black ink. As again, going back to baseball, keep getting on base. Keep getting on base. Every now and then, there's going to be a wild throw to first base. You might turn and go to second. All right? You might even be able to get to third. Singles can turn into home runs. We've seen it happen. But you can't make a home run if you're sitting there on the bench or you keep striking out. All right? So at some point, if you keep printing red ink, just say to yourself, okay, whatever you're doing, slow it down, take smaller positions. Yes, take smaller positions. Don't take bigger positions. You're not going to make back what you lost on the next trade. Get that out of your mindset. All right? If your team is down 20 points going into the fourth quarter, you're not going to make 20 points on the next possession. All right? Be constant, go hard, but you're not going to make that up. Same thing with the stock market. When you lose money on stocks, when you're trading, you lose money, the next trade's not going to make that back. Don't even have that attitude. Have the attitude, I'm going to chip away at it again. I'm going to go at it. I'm going to eat. How do you eat an elephant? One bite at a time. So don't go into these trades saying I'm going to make all my money back on the next trade. Just chip away at it. Chip away at it. Chip away at it. And if you follow my strategy, every now and then, guess what? Bingo. Doubled in price. Bingo. Doubled in price. Now, if you don't believe me, guess what? Do the numbers. What have I recommended to you? Snow. It went, and I told you, 319 to 404. Who else did I recommend? Palantir, PLTR. Recommended that on the move through 11.32, which was about $12. It ran at $30. There was a double. Who else did I recommend? CRSR. Unity software. Unity, I forgot Unity software. The list is endless. So if you miss one train, don't worry about it. If you go through a streak, and trust me, we're going to have some streaks where you're losing money, it's okay. Just don't have big losses. Cut your losses. And if things aren't going well, decrease your size and get back on the path of making money. As you get back on the path of making money, you'll increase your size and everything else. Well, the reason why, Twin, I didn't bring up EPAM is EPAM was not an IPO. EPAM was just a earnings play. So I got that on the earnings play, on the earnings breakout, and I'm still long that. In fact, I'm still long EPAM, and I'm also from the earnings. I'm also still long, what's the other one? God, I'm looking for it now. I just had a brain freeze. ServiceNow. Geez, ServiceNow. Symbol NOW, ServiceNow. That's the other one. That's okay. Twin, that's okay. Those are, again, all I'm showing you help me prove one thing. The strategies do work. They do work. This is the reason why you don't want to lose money on, for me, I don't want to lose money on some stupid trades. I'm not going to lose money on, I'm not chasing behind a stock saying, wow, if it just gets back to what I paid for it. I'm not wasting my time with that. And the reason being is because there's another train coming, guys. Your job is to help you, what I'm doing, helping you with, and your job is to help you recognize these trains as they pull into the station. And then you get on it. You don't want to see the train pull out of the station and go, oh, Dad, look at that. I should have got on that train. I'm trying to help you recognize the trains that you want to be on as they're at the station and giving you a chance to get on that train. All right? If the train's not working, I'm going to have to get off on the next stop or the next two stops. I'm not going to leave you on there all day. But that's what we do. And again, I know I'm saying a lot of things. Sorry, I'm just reshifting here. But let me say this. One last little point. I do not believe in adding to losers. I do not believe in dollar cost averaging for what we do. I do believe that if you want to add to your position, wait for the stock to pull back, consolidate, and when it starts its next run and breaks through that old price range, then you buy it. All right. It's all about timing for me. I don't want to be in a losing stock forever. I want to be in great companies, and I want to be in them when stock prices are going up. I want to make my money. All right, it's quarter till. Any other questions? I got plenty. I got a few more minutes here, so I'm open to questions. I do appreciate you guys. Hopefully, Will, I answered your question about snow and Airbnb. Twin, I got you. Stay open, computer. Let's see, anything else? I got the AI, Upstart, Wish. Those are the ones I'm looking at. SEER, those are the ones I'm looking at right now. Let me see what else. Great question. What is syndicate bid? Great question. Syndicate bid, when a company goes public and the investment bankers set a price. I'm making up numbers now. Let's say that, well, I'm not going to make up numbers. Let's say that, I'm not sure who else opened. All right, let's say that company goes public and the investment bankers with senior manager priced the stock, the deal at $20 a share. At $20 a share is the syndicate bid. That $20 price, if you ever see the stock sitting at bid 20, offered at $20.05, that bid at $20 is typically going to be the investment bankers. Part of the agreement, the fee that they collect, is that they tell the corporation, we're gonna help the stock make an orderly market. An orderly market means that if the price of the stock starts to drop, they're going to step in and hold that bid. All right. Now, they're not going to hold it forever. They're typically going to hold it for up to 15% of the actual size of the deal. So if the deal issued 10 million shares, they'll probably buy up to 15 million shares, which is called 1.5 million shares on 10 million, my math. They'll sit there with 1.5 million shares trying to short, that's what they'll be short, 1.5, and they'll sit there trying to buy stock at $20 to hold that bid up. Now, typically on hot deals, deal price at 20 opens at 25, the investment bankers have done their job. They're probably not going to be bothered with it. They don't have to, because the natural buying from investors, from institutional investors, has pushed the stock up. They don't have to sit there on the bid and buy it. You'll see them sit on the bid with really bad deals or flat deals. And if the deal is really bad, they're not even going to sit there on the bid. They're just going to disappear. So today, when Wish went public, the investment bankers didn't even make a stand at 24. They just backed off and let it go. They came in and it looks like it opened up at 23 and change. So they must have come in around 23, and that might have been where their bid's at. But they didn't hold it. Now you'll see them now. Watch what I say. You'll see that they might, believe it or not, on Wish, WISH, you might see the investment bankers try and push this thing back up to 24 and even break 24 when all the selling pressure kind of stops. I'm here to tell you something. If this thing breaks 24 and there are options available, I can borrow stock, it will break 24. I mean, when it breaks above 24 or even breaks close to it, I'm telling you, I'm going to short as much as I can get. I'm going to short it. No question about it. I've seen this 1,000 times. The deal's in horrible shape. They couldn't get it done. Understand, they couldn't get it done at 24. They priced it at 24. The book was not there. And as soon as they worked the thing out, it started going down. This is a prime example. I had told you last week, be careful. Some of these investment bankers, some of these corporations are going to push things out at the year end because they want to be public before the year end, even though the company might not be ready. And here's a prime example. Looks like Wish got pushed right out. I'm trying to think. Hopefully I answered your question about what the syndicate bid is. That's the investment bankers sitting there buying. Now, the investment bankers will not sit there forever. They'll sit there for a day, maybe 2, 3, try and hold their stock up, but they're not going to, again, they don't have unlimited capital, one. And there's a little rule called the green shoe rule. The green shoe, named after the IPO that first did it, the green shoe rule allows the investment bankers to sell up to 15% more than the offering to become short. So let me explain what I'm saying. Let's say the deal was priced at 20. I said that they did 10 million shares. The investment bankers sold to the investment public not 10 million, but 11.5 million shares. They sold the 10 million shares that the company was bringing public, and they sold another 1.5, which is the green shoe. So virtually what the investment bankers did is they got short 1.5 million shares at 15%. Welcome, Boo. Glad you can make it. So they got short 15% of the deal. So what that means now is that the investment bankers are short 1.5 million shares of this stock, and that they have to go into the open market and buy it back. That's how they support the deal. They go in the open market and they buy back green shoe stock. All right. Again, I know I say it a lot, but I'm going to say it again. In order to win the game, you must know the rules of the game. If you don't know the rules of the game, if you win, it's going to be by luck. You're not going to be able to consistently win if you don't know the rules. Part of what I'm talking about today are just the rules. All right? That's what the investment bankers can do. So again, on Wish, company, the deal's in bad shape. And by the way, we talked about this with ADT last week. We talked about this with Casper. Wish is not the only one. All right. So just know that that's what when I say syndicate bid, that's the investment banker sitting there buying it. The hotter the deal, when the deals open up at a huge premium, the investment bankers typically are not short, and they also are not sitting on the syndicate bid. They don't have to. So case in point, when Airbnb went public last week, when Dash went public last week, the investment bankers did not have to sit there on the bid. They let it go. But what's interesting is neither stock has even come close to its bid price, but that's what's going on. Syndicate bid, I should say. All right. Any other questions that I can answer on IPOs or anything else? Let me say this, by the way. For those of you who don't know, and I say it again, there's also what they call the secondary public offerings. This is when companies that are already in the public come to the marketplace and issue more common stock. How can I put this? Percentage-wise, return-wise, I made more money on IPOs in terms of percentages, in terms of returns, percentage returns. In terms of dollar amount, I made more money trading secondary public offerings than I ever made from IPOs. And the reason being is because when secondary offerings, I could get size. I could also, not only could I get size, but I could also get short the stock. If it was in bad shape, I could get long. I didn't have time to do it today. When you get a chance, somebody type in this symbol for me. Nancy Frank Edward, NFE. NFE. Name of the company is, make sure I get this right. The name of the company is New Fortress Energy. Stock closed yesterday at $56.72. All right, $52.76. And the corporation, and by the way, and this was at $56.72 was the all-time high. All-time. I'm not sure if it's all-time. I take that back. It might be near term. Let me check my time. I can't run out of time. I want to keep this recording. Oh, no, I'm right. So the stock basically broke through its old all-time high, which looks like it was about $55 a share. Today it went to 56 and change. And then now it ended up closing at $47.79. My only point in saying all this is that they priced the deal at $51. They opened up the stock at $52. They ran the stock up to as high as the all-time high today, which was through the all-time high, which was up at 56, and then they end up pulling it down and closing down. So that's one of the things. How do I know when the secondary is coming? There's two ways you can check. One is I have a service I pay for that sends me information on when secondaries are coming. I pay for this service. There's a number of them out there. And also, the other thing too is just the news service that comes across that I watch. I just watch news. So I'm always looking. Another thing I do too is, believe it or not, is I check the SEC's website for IPO and SPO filings. So I do check that too. So I have a lot of information coming at me. It's one of the things I check. And this book is harder to write, but once I get done with the IPO book, I probably will start the SPO book. A little harder to write, a little harder to trade, a lot more moving parts, but at the same time, the underlying strategies is very similar. So I'll explain all that. So the reason why I brought up the NFE, again, they just did a secondary. Price the stock closed at, repeat, the stock closed at $56.72, the previous close. And then, bear with me. I'm on a weekly chart. Let me go to a daily chart. Yeah, so yesterday stock closed at 56 and change. And then again today, priced at 51, was up at 52, opened at 52, and then it ended up selling off at 57. So here's a Milliganism. One, now you hear me say this, and I don't say this often. One, I would have shorted the stock at 52. I didn't, by the way. Shorted the stock at 52 when it opened up. When it broke 52, I would have got short, which, as you can see, at 51. When it broke 51, I would have got short, which it did. Went down to, it closed today, low at 47.26, closed at 47.79. So it also has a very nice upward trending chart. I'm not familiar with the company. So what that means is at 57, 58 down here, I would probably cover, look to go long, and look for this thing to attack the 56 number. So I would have made money on the downside and make money on the upside. That's the one reason why I made more money in the SPOs, is because I could get short the stock, I could get long the stock, I could also trade in size, so it allowed me to make a lot more money. Yes, you cannot short stock in Robinhood. It's one of the reasons why I moved my daughter's account from Robinhood. Cannot short stocks in Robinhood. So it's the reason why I don't trade with Robinhood. Sorry about that. There are other companies you can go to. TD Ameritrade has no commission. I think Charles Schwab has no commission. So there's a number of sites you can go to that have no commission that you can actually go and trade, and you can get short stocks. Now, I believe, I'm pretty sure on this, in order to short stock, though, you have to have at least $2,000 in your account. If your account's under $2,000, you cannot go on margin, which means you cannot short. But again, you might not be able to short, but there also are options. Now, the one problem that you have with options on some of these securities is, I'm running out of time, so I got to shorten this up. One challenge you have with options is you got to check your premiums. Premiums could affect your profits. All right, guys, as you know, I want to say these recordings, I'll post this on IGTV. I'll also post it on my YouTube channel. So you can check it there, check it here. I appreciate you guys, and I will see you next week. Professor Milligan signing out once again. Make money, tell me all about it, guys. Keep making money, tell me all about it. Have a great week.